I think that you need to have somebody who's going to explain the process to you and walk you through the process step by step, what you're learning, but at the same time, they're leading in the right direction.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying the show and getting some good value, do me a favor and help me help you. Leave us a rating and review. Tell us what you love about the show, but also give us some honest feedback so we can make this show work harder for your investing goals. And if you haven't done so, make sure you hit that subscribe button so we don't miss an episode. Now, we got a great show today. We're going to be talking to Ralph Dibugnara. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Ralph Dibugnara is a nationally recognized real estate expert who serves as president of Home Qualified, the digital resource for buyers, sellers, and real estate agents driving today's millennial market. He is also the vice president at Cardinal Financial, a nationally recognized mortgage loan company behind $28 billion worth of closed loans. Let's welcome to the show, Ralph Dibugnara.
Nice to be here, John. Thanks for having me.
Absolutely. Ralph, I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. I've been in mortgages. That's really my day-to-day for about 24 years at this point now. I've been in since about 2000, 2001, around that time period I came in. So my daily basis is really running a mortgage company. We have about 58 branches in 9 states, and we do somewhere between $1.5 billion and $2 billion a year on the residential side. That number has been a little bit skewed the last year and a half with everything's going on, but that's my real day-to-day. I started buying real estate probably 20 years ago, a little bit over 20 years ago. I bought my first property. I kind of rode the wave up to 2008. I went through that craziness. I lost a lot of it. And then I would say that I restarted 80% of what I have right now, probably around 2013. And then for the last 10 years, I've had a pretty good run in buying stuff and a couple of different strategies. But yeah, it's been an interesting journey. I know the cycles of real estate at this point now. I'm a New Yorker. I grew up in New York. I live in New Jersey right now, right over the bridge. But I was born and raised in Brooklyn. I lived in Manhattan for a long time. And then I kind of moved, when we had kids, we moved over the bridge, more space, and now I'm in Jersey.
There you go. Love it, man. You talked about being in this industry for, 20, 24 years at this point, getting into the mortgage space, becoming an investor yourself for the last 20 years. Like a lot of people, had some down times when that last economic downturn hit, but you started rebuilding that portfolio to where you're at today. So I really want to talk about 2 different topics, right? First, I want to talk
Sure.
about the mortgage business, and then I want to talk about investing. But, how did you get into the mortgage industry?
I graduated college kind of because I had to. I wasn't a great student. I graduated college with a finance degree, but I just kind of made it through. And when I got out, it was the dot-com bubble. It was that first bubble when all the internet stocks had blown up and pets.com and all these things. And we were really in a down economy. And with that down economy came low interest rates. So when I was out looking for jobs, they were really only sales jobs with my qualifications. And I had a friend who had gotten out of the Navy and he had taken a job in mortgages. And I was just about to take a job with Enterprise Rent-A-Car for the management training program. And he's like, "Oh, what's going on? How's life?" I'm like, "Hey, I'm just about to take this job." He's like, "Don't do that. Come do this." He's like, "I'll get you into the loan officer training program. Out at a company, we're going to go public in 2 years. Interest rates are down. It's a great time. It's a great time to be in the business. Why don't you come check it out?" So I just went and checked it out. And I took a sales job as a loan officer with no pay, commission only. And I had enough money to kind of get me through probably about 2 months. And I was able to make it happen because at the time, rates had dropped to 6%. And that was the lowest they'll ever be in history. You know what I mean? So everybody was refinancing. Everybody was really refinancing. So, I came in and it was as long as I worked, it was business. So I was able to kind of really make my way pretty quickly, and that company eventually went public, and I excelled, and I ended up running a pretty large group there, and then I kind of rode that, and I think in 2008, I was responsible for like 200 people at that point. At 2007, I was responsible for like 200 people at that point, and I never forget. I was kind of walking up the block. My office was in Federal Reserve Plaza in downtown Manhattan. I lived like right on Wall Street, so I lived like half a block away. So I was walking up from my apartment to the office, and I got an email that said, "Hey, we're eliminating all these products." And I was like, "That can't be. That's 95% of our business." And sure enough, I got there, and that was the case. I went back to my apartment, and I literally watched like the free fall. Lehman Brothers, Bear Stearns, and everything just kind of started to go, and it was a bumpy. I would say 3 or 4 years after that, just trying to like stay in the business and get reestablished, and companies closing, and it was just it was humbling. It was dark, but it was probably the thing that's helped me the most in my career.
I think it's crazy because it's, you talked about just kind of fumbling your way through college, just
Yeah,
getting
yeah,
through there. Sometimes you just show up enough, it'll get you across the finish line. But I
yeah,
think at that point you realize, okay, man, maybe I should have applied myself a little bit better. Looked at
definitely.
the opportunities close to taking that job for the rental car company. Your buddy tells you, hey, come work with me in this loan officer program. You do that and really find your niche, right? From 2000, early 2000, right? 2000, 2001, from that time in just 6, 7 years, you were managing over 200 people. So obviously you were
Yeah,
doing something right and rising up that business to kind of grow to that level. So, I think that goes to show how hard work can pay off, the
definitely.
hustle mentality and leveraging your skills. Did you already know that sales was kind of your thing, or was that something that you
No,
kind of grew into?
I still don't think I'm a salesperson. So no, I would say no. I was kind of a shy kid. I was always a hard worker, but I was really like not very outgoing. And then I get on the phone, and we were a national company in 50 states, and I had this strong New York accent that I didn't even know I had. So I get on the phone, and I'm talking to people from Texas, and they're like, "Where are you from?" And I'm just like, "What are you talking about?" And like, so that didn't help. And then just but like you said, like just consistency and hard work, like just showing up every single day. Um, it was a numbers game. Like if I take this many applications, I can pull this many credits, I can do this many loans, and like it just started to become a numbers game for me. And I was like, if I go put in a 10-hour day, I know that I can do this. And like I think once I got my first paycheck, um, that was a significant amount. And I saw that there was no ceiling on how much money I could make. It just made that hard work that had my father was a very, very hard worker, and so was my mother. And I think I had that growing up. I had at least that. Like we didn't have a lot, but they worked their asses off. So I think I always saw that, and that was really ingrained in me. And that really kind of propelled me to the next level. And then once I started making money and I started kind of rising up the ladder, I kind of got the confidence, like mentally, like, all right, well, I'm not lesser than everybody else because I didn't do well in school, and I can sit in a room with these people, and success and consistency will breed confidence, like and I just think that in everything in life at this point now, because of that, I'm ingrained in like repetition. Like I know if I do this a thousand times, then I'll get good at it. So just keep doing it, even though I may stink at it now. So repetition has kind of become like really my superpower, right? Like I'm willing to repeat things a million times to get good at it.
It's that resiliency too, right? Being able to show
Yeah,
up and not put too much stake into the result you get today because you know that, hey, if I keep showing up, eventually it'll go my way. I love hearing your story too because it parallels mine in some ways. Because one, I was in the automotive industry. I was at GM when the
okay.
economic downturn happened, and I remember feeling like, almost a why me, and not to that extent, but just like out of every industry to pick. I mean, that was the first one that you
Yeah,
saw,
yeah.
and it wasn't until Lehman Brothers that I was like, oh, this isn't just us. Like this
It's
is this is
everybody.
a whole U.S. thing, right? Because at first it was just the U.S. auto
Yep,
industry,
that's
and it
right.
was
That
just
went
us.
first. People forget about that. They think
We
about
went
banking and
first.
they forget auto went first. You're
So
right.
I remember, feeling like, man, I got to get off this sinking ship, right? And then once the banking industry went, I'm like, oh, okay, this everything's gonna implode and we're all gonna be in the same boat. So let's just figure this thing
Yeah,
out. But you talk about that resiliency, and I think that's so key because, we've got to find that within ourselves. And sometimes, people they have great degrees and go to great universities, and there's nothing wrong with that. That's phenomenal. But maybe they're not working, as hard because they feel like
Exactly.
they have kind of that credential. And I think when you don't have that, you have a little bit of a chip on your shoulder where you feel like you have to prove yourself. And I think that obviously served you really well in your career. Now, talk to me about, we talk about the mortgage industry, we talk about loans. As an investor, I'll be honest, I don't really know that much about the loan business, right? And when I
Sure.
think about it, if I'm looking to buy a property, I call my bank, I call my lender, and say, hey, I'm looking at this property. What kind of loan product can I get? They help me out, and we're off to the races there. But can you just peel back the onions a little bit for some of our investors who don't really understand the mortgage or the loan industry to help us
Sure.
understand like how it works and maybe how we can take better advantage of that loan business?
Yeah, I mean, I think as buying your first home in this country at this point now, that starting there, that's become a actual easier process in my opinion, and because so much of the economy in this country runs on real estate. And I'm sure you talk about that, right? Like so much connected to real estate. Now with the downturn in the market because rates are up and there's really not a lot of homes for sale in a lot of places. With the government agencies like Fannie Mae, Freddie Mac, and FHA, they're really trying to stimulate the market any way they can. So now there's probably, I don't know, per state, there's probably 3 to 4 down payment assistance programs that are available for first time home buyers that aren't even necessarily connected to income. They just, hey, you're a first time home buyer, you live in the zip code, you'll qualify. And I think that that's twofold, right? Because how we got in trouble in the mid 2000s with all this 100% financing and this over leverage and that kind of stuff. But the way it's being done now is being done differently. It's being done smarter. And I also feel like some of the reasons we have down payment assistance programs is because what I perceive to be the next market is I'm assuming the overall feeling is that rates will, it's not, when it's not if interest rates to come down, it's when it's going to happen at some point, right? I don't think it's going down to 3% again, but they will come down. When that happens, inevitably, because we have a housing shortage, prices on homes will go up, right? So no matter what's going to happen, we're going to have an increase in prices because more people will buy and prices will go up. I think because of that, the government's willing to put out these down payment assistance programs because they really feel like people are going to have, if they buy now, they will have equity in the next 5 years, right? So that they're betting. I believe that they're betting on that. So there's grants and there's down payment assistance. So as a first time home buyer, like getting into your house, but 2.5% down or no percent down right now is very very realistic, right? Once you get past there, and I've passed this threshold where you buy a second home and you buy your first investment property, and the down payments start increasing. Um, I think as an investor, you start to look for, well, how do I access more capital? And how do I get, how do I start, I have investors call me all the time. It's like, hey, I just want a line of credit. You got to get to a point as an investor where not only can you show a track record of buying homes and paying on time, but that your model is profitable. And I think as an investor, once you get to a point where you're showing that you can make a model profitable, then you can go to some of the banks and some of the bigger funds and say, hey, I'm looking for a line. I want someone to extend something larger to me so I can start buying properties. But I found that even that at this point, they still want to see what you're buying, right? They're not going to underwrite the deal strictly every single time, but they still want to see what you're buying. So even for my purposes, I'm an industry insider. I have a pretty significant portfolio. I can't just call blanche, go and write a check unless it's against my own properties. If somebody's giving me the money and say, hey, just trust me. Like they still want to see the collateral. So I think that, you kind of scale up to what that is. But if you can show a profitable model, you can get access to capital to kind of keep doing, more and more as far as growing, scaling your portfolio.
Yeah, and I think that's the big thing, right? Is for most people, you either have a deal flow issue or you have a capital issue.
Yes,
And
yes.
if you can figure out the capital side, that opens up the avenues to really hone in on your marketing and get the deal flow and things like that. There's obviously the equity you need, but then there's the lending side of it. So talk to us a little bit more about maybe how our lenders can partner with us or things we should do to better
Yep.
position ourselves to have access to more capital.
Yeah, so I think you kind of just hit it on the head with what you said, right? So lenders right now are really, really happy with their rate of return on money, but they're unhappy. They don't have the deal flow. So like there is a lot of capital out there right now kind of sitting on the sidelines because, including mine a little bit, like, just trying to find like pockets where it makes sense to buy. And so, I think to make something, and, I'd like to get your opinion on this too and your feedback on this. You talk to so many people. When people ask me about cash flow right now, my answer always is unless you bought a property that's paid off or you bought it when interest rates are low, buying a property today with where interest rates are and where homeowners insurance is, which I think has become a real problem over the last 12 months, it's very hard to say, hey, I'm going to cash flow on this property X amount of money. I think the hope is in buying properties today is to be able to show a model in the past where you were profitable based off of the properties you bought, and those properties are have equity, they're self-sufficient, and they're making some money, and that you can show a model that you're willing to buy today where you can at least break even. Like, so I think for stuff that you're buying today, banks want to see that you're at least going to break even, because again, everything is up, and everybody realizes at that point that you're going to have a point in the next two years where you can refinance and lower your cost to kind of increase the income on these properties. But I'm not seeing a lot of deals right now when investors bring stuff to me and I'm like, oh, this is gonna cash flow X amount of money. It's hard to cash flow right now. Like, your money, even if you're cash flowing, your money is the small amount of money you're getting is going back into repair. So I think what investors are looking to say right now is that you're buying something. What lenders are looking to say is you're buying something that's got some upside over the next 2 years, and that you could at least show a break even right now, and that the property is not going to be at a deficit every single month.
Yeah, no, we're definitely seeing the same thing, right? Cash flow is hard to come by. And, for our model is pretty straightforward, right? We want value add properties that have some cash flow in place. We like to stabilize cash flow once we kind of implement our business plan. And then ultimately we control when we exit. So there's an equity play there, but we have some flexibility on when we exit. And it's been a challenge to find, deals that fit that model, that equation. And you're right on the lenders, on the commercial side of things, they look at a couple different metrics, but one of the biggest ones is DSCR, right? The debt service coverage ratio.
Correct.
And what has happened over the last couple of years is I think a lot of people, a lot of investors have acquired properties with a business plan to, renovate it and drive up rents and drive up the income. So they're buying a property with maybe a DSCR below one. So this is the negative cash flow property, but they have a vision of getting it up to 1.25 or 1.3,
Yeah.
whatever it is. And the challenge is when interest rates started to move, or we saw rents, in some markets, rent growth has actually stopped or gone the other way. Well, now they're not able to hit those numbers, right? And that's where people are getting into trouble. So I think a lot of lenders, are very shy and sensitive and are risk adverse. They don't want to
Yeah.
take on that risk, and I think that's why you're seeing a little bit more of a friction in the marketplace as far as what kind of deals lenders are looking to put money on.
Yeah, I agree. I mean, we have a couple of investors that'll still do some kind of negative DSCR, but not many. I mean, it was a lot more before. At this point now, they want to see something break even and positive, and I think, a lot of things factor into it. But you said something too that I think is important. I think that's where I've kind of pivoted the last 12 months as an investor. Whereas I'm not necessarily looking to acquire new properties. I'm looking to see how I can improve the properties that I own by adding amenities, by rehabbing, by renovating. I'm putting money in there instead of putting something into something new to try to get the cash flow up on it, because I know if the market turns and I can refinance them and we get some stability, that cash flow that I'm creating is going to become even more and more, especially as I pay it. So I think that is a key right now, is like, what's the plan to improve what I'm buying, right? How can I improve on what I'm buying instead of necessarily, because it's, where I am specifically, I mean, in New Jersey, there is no inventory, like nothing. So it's like, I'm in Bergen County, New Jersey, and if you look that up, where I live, it's either one, two, or three highest tax states in the whole country, highest tax counties in the whole country. In this county, the amount of homes that you can find under $1 million, I bet you it's less than 100, maybe even less than, and it's a large county, right?
Wow.
And it wasn't that way, right? Like, so the prices kind of accelerated. Obviously a lot of people moved over the last 3 years, and now, so how do you find deals? Like, because to take on a risk of something that's going to cost you seven figures, like to take on that kind of risk with high taxes and insurance costs up, you got to really have a plan going into something like that. So like, and I don't only buy here, but I'm just trying to use that as an example of kind of what we're looking at. So then you start to look at other states. I own a lot of properties in Florida. I knew this from experience, but I saw the report about yesterday. Florida is the highest cost of insurance in the country, right? So it's like, are you taking that into account? Like, so I think every state, no matter where you are, you're dealing with some kind of increased cost, and that's what comes with inflation, right? So when inflation's so high, all costs are up, everything is up. So it's just, I'm kind of resetting in a way, and kind of looking at what I have and seeing how I can improve instead of like I have to find something today. I need to deploy this capital. You know what I mean?
Yeah, Ralph, I think that's a good point too. And the other thing that I'll call out, which you just said, is like as investors, it's easy for us to watch the thing we know when it goes up in value and use
Yeah,
that as a reason to look elsewhere. And what I mean is you looked in your county and said, hey, wow, these home prices have shot up crazy, right? All these homes are now over $1 million. And then you start to look elsewhere. Well, that happens everywhere. That's the challenge, right?
yeah,
So I'm here in Cincinnati, which is one of the most affordable markets in the country. But I remember when, some of these properties were much less. So what I find is it's harder for that local because sometimes you
yeah.
have
You're
that
right.
knowledge of where the
That's
market
a good
was,
point.
right? You remember 10 years ago when you could get that property for $100,000. It's really hard for you to come to grips with paying 4 times that amount in today's market, right? But if you go to a market that you're not familiar with, it could look like a steal. And I see that all the time. California investors, they come here and oh, you get this property here for 100,000. Like, yeah, you could have got it for
Yeah,
30,000 five
yeah,
years ago,
yeah.
though, right?
No, that's
So
an
that
excellent point.
inflation hits
Yeah,
everywhere across the board,
yeah.
and we're all chasing yield.
Yeah. No, yeah, that's an excellent point. You're right, because it's the market, right? Like you're like,
Yeah.
what well, this isn't supposed to, how is this much money? But in reality, that's what it is. So that's a really good point because you almost get too familiar with it. It's like the girlfriend you get too familiar with, right? You're too familiar, you take it for granted that there's still value there. And there may be, you know what I mean? So it's that's interesting.
Yeah, man, it's interesting as investors. I think we always, are looking for that opportunity, but sometimes we have to be more we just have to come to grips that, hey, things are just going to cost more in the future. So if you still think the value today is fair, not based on what it was,
Yeah.
3, 4 years ago pre-COVID, but if it's fair based on what things are going for today, then project out in the future. If those fundamentals are still there supporting it, then it may be some upside and opportunity there. Hey, when investors and not just investors, but anyone really, when we're looking and shopping for kind of a lending partner, a mortgage
Mhm.
banker or someone to be on our team, what questions should we be asking?
Yeah. So a couple of things. So I think the most important thing is everything, obviously technology is changing everything, right? But there's still a craft portion of this business where the person you're dealing with has to know how to look at certain things before he inputs it into the technology. So as much as technology is replacing jobs, there's little things that can screw you up or cause you to get a higher interest and stuff like that. So I think the first thing I'm looking for is experience, and somebody who's detail oriented, that's going to look at things a certain way to make sure that I'm not missing something. And we get kind of caught up in interest rate all the time. And truth be told, somebody's in the business for all this time. We're all very close to the same, right? Like depending on the day, depending on the hour of the day, depending on when you talk to me, I'm going to be the same rate as somebody else, or with an eighth or a quarter of a point of that person on any given day. And the truth of the matter is that if you compare apples to apples, hey, I called Ralph at 1 o'clock and I called Jim at 1 o'clock. They're probably the same, right? Like, it's probably exactly the same. But, you may have called me a week ago and you've talked to this person today and there was a big shift in the market, whatever, and great change. So, I kind of, it's hard to do this, but I kind of implore people not to focus on interest rate, right? To focus on a good partner who's knowledgeable, who understands the market and who's detail oriented, because, something on your tax return, something in your bank account, something on your credit report, something small can mess up your transaction and either cause delays, cost you money, or cost you something that's going to be long term, right? So I think take some of the focus off of rates and really kind of focus on, hey, what products do you have access to? Can you give me an idea of a few different options for what my scenario looks like? Um, how much experience do you have with this type of lending? I think that's important, right? Like, are you used to dealing with investors? Do you understand the type of property I'm buying? Because yeah, I can do loans in 50 states, and I can underwrite anything anywhere. But underwriting in Cincinnati, a property in Cincinnati, is different than underwriting a property in New York. Like, there's a nuance to these properties. There's a nuance to the people who live in the area and the jobs they have. Try to underwrite somebody who's a union worker in New York City and compare that to it's they. When you're a union worker in New York City, you work for 15 different companies in a year, and that's normal. But an underwriter's got to understand that. Like, why does this guy keep hopping around jobs? You know what I mean? So it's like, I think somebody has to more specifically understand what you're buying and where it is, and they need to understand that specific area, because that could make or break on a deal.
That's a great insight, right? Focus a little less on rates because rates are fluid and, for the most part, no matter who you call, they're going to be somewhat similar or comparable, right? If
Correct.
the numbers are different, it's because there was probably a shift in the market, not
Yeah.
necessarily because one lender is better than the other. But the things you should focus on are experience, particularly experience with the business plan or the types of products you're looking for. Is this person detail oriented? Understanding you as a buyer, understanding how you're looking to structure the deal, making sure that they understand where there might be potential issues that could cause delays or cause this property to, the deal maybe to stall or to fall out. And then the last thing, their market knowledge. How familiar are they with that market? Do they understand that, again, someone who's a union worker in New York, is going to have different employers on their resume. So, they got to be able to massage that and make sure everyone
Yeah.
understands that, hey, this person's not job hopping. This is just the way, the unions work in that business. I think those are really, really good insights. And particularly, again, focusing less on the rate and more on the actual
Yeah.
person or partner. That's going to be the best way for you to get the right lending partner for your business and for your investments.
Yeah. And for any lender, by the way, just one more point to that. We could get three interest rate changes in a day, depending on how volatile the market is on that day. So it's important to kind of understand that.
No, I appreciate that. And I know you're an investor yourself, right? So you talked a little about kind of your portfolio and what you're looking for. What do you see kind of moving forward, right? As far as trends, as far as things that you're kind of keeping your eye out for, what are you paying attention to?
So, my portfolio right now is probably 50-50 long term and then short and midterm on the other side of it. And I really got heavy into kind of the Airbnb business, which has turned somewhat into midterm business. Um, I would say around 2019. And it was great during, the post COVID and those kind of years. And it was a booming business. And now, if you ask me in the last year, if you would have asked me in 2021 and 2022, which side of the business you like better, I would have been like short term, definitely. Now it's like, well, I bought these long-term rental properties at low interest rates. They cash flow a couple of $1,000s a month. Those are easier because I'm getting a lot more vacancies on the Airbnbs now that I didn't have before. So, I think the market shifts. So from I'm a lot of my experiences in residential. So my outlook right now is that I'm always going to believe in a long-term asset, right? A long lease, a long-term asset, at least that's over 6 months to a year. I think it's always a great place to kind of park money. I think it's very secure because there's not a lot of turnover. Depending on what state you state you're in, because New York and New Jersey have tough tenant laws, whereas it's hard to get people out if you have bad tenants. So it's something to kind of take into to point. For the short-term rental market, Airbnb, I think if you're looking to get into that market, you have to look at it in two ways. I think one, as an Airbnb owner, there's a ton of hospitality companies that have come into the fray, right? So you're competing against people who do this for a living. So unless you're willing to kind of put that kind of effort into it and the research to say, hey, my property here is competing against this property here, which is the same property, and they have this kind of amenity, and they did this and they did that. Like you have to, it's a fluid thing. Like I'm constantly looking at prices and daily rates and how are people lowering the market, are people exiting the market, are people coming in. So it's gotten much more competitive, and at the same time, it's going to be there's going to be less people in the market, I think, over the next 12 months because I don't think people can handle the instability of it, the vacancies. So I think there's some opportunity there to buy a property that may have been an Airbnb property that somebody just can't handle the mortgage because they're not getting rent every single month and they're looking to move the property. So I think but I think if you're going to be in the short-term rental market, you want to look at the midterm rental market also. So midterm is anything I consider anything over 30 days, but kind of less than 6 months. So all my properties I'm trying to make available for both at this point now, which I wasn't doing before. And it's important if you're going to do one to do both. You're going to go on a site like a bigger podcast or something like that, and you're going to get someone they're going to do a podcast that says, I'm only focused on midterm rentals right now, midterm rentals and midterm rentals. And I don't know if that's the best advice in the whole entire world, if I'm being honest, because I understand why investors like it because it's less competitive. There aren't a lot of hospitality companies there, right? They're really focused on the Airbnb stuff. But you can't just have something, and they'll tell you like the sources of business are Airbnb, Furnish Find. This is a really good one. Look up your relocation companies. Look up areas that they're building bridges and long-term projects that people are going to need to stay for long periods of time. But for the general investor, they're not going to have a lot of access to that stuff. So I just don't think, I think some of it is good, but I wouldn't make a whole portfolio of midterm rentals, right? I would combine short term and midterm and kind of make it that way. So that market is suffering today, but I think there's a lot of upside in the future to it. I think that as long as you're buying, I like vacation areas most. But nothing is foolproof. Like I'll give you like South Florida this year. I have I think 3 properties in South Florida this year. It's cold for Florida. It's only been like in the 60s and 70s. Like I can't predict that's going to happen. Like even if I read the Farmer's Almanac, I wouldn't be able to predict that, right? So like my business has been down because it's been colder. So like some of it's hard to predict, but I found that my properties that do the best are my properties that are the least seasonal. So they're rentable anywhere between like 9 and 10 months, and that may mean they have a cold weather season and a warm weather season, or they're in an area where it doesn't get too cold and it doesn't get too hot, right? So I think those are the most foolproof areas to buy in. I think there's going to be, I think over the next 6 months to a year, there's going to be some opportunity in that market because I think people are starting to suffer. I know I'm suffering. So and I think I have 15 short-term slash midterm rental properties. So I have a pretty good base, and they're in 6 different states. So I can kind of speak to what that is, and I know that I'm suffering overall. So I think that where there's suffering and people are running out, there's opportunity to run in, and I think there's some opportunity there.
Yeah, and you talked about the portfolio, right? Having a mix of long-term rentals or your traditional, rentals, as well as a mix of short-term rentals and even some midterm rentals put in there. In that there might be some pain for short-term rental owners.
Yeah,
I like the fact that you talked about the balance of short-term and midterm. I know a lot of folks have kind of looked more at midterm. Talking about again those construction projects that are taking place, or relocations. Traveling nurses is another one that's really
yeah,
big in that midterm rental space. But again, that balance of short term and midterm, when you have that, is definitely key. But again, for folks who bought specifically for short term rentals, maybe those numbers are a little bit down. Competition is up. These big hospitality companies, they got it right. They're figuring it out. These hotels, they're putting up their own boutique shops now. So
yeah,
there's a lot more competition, and you're getting pushback from different communities, right? These local
yeah,
communities
definitely.
are pushing back and saying we don't want this here. So certain markets are still thriving, but some are certainly suffering. So as an investor, you want to pay attention to that and recognize where there might be opportunity in the future. Real quick, I was going to move to our round of insights, but you've talked about having short-term rentals, 15 of them in 6 different states. I know most of your long-term rental portfolio sounds like it's more in your backyard, but it sounds like you do have some
Local.
stuff
Yep.
in other markets as well. How are you managing this portfolio? I mean, do you use third-party management companies? Are you self-managing everything? What does that look like?
So we still manage mostly in house, which is not the easiest thing in the whole entire world. But I have people in house that we manage. So you're right about the long term rental stuff is mostly local, right? So it makes it easier. I try to automate as much as I possibly can. For the stuff that's out of state, it's almost all the short term, midterm rental stuff. So automated locks, cameras, automated thermostats, as much as I possibly can. In those markets, the reason we still kind of manage all the stuff in house, specifically for the short term, midterm rentals, because reviews, the reviews of your house and people stays are the most important thing possible, right? Handing off to a management company can be dicey if they're not as attentive as you are. So, my wife Beatrice really handles the bookings, and that's all she handles, just bookings, and that's a job in itself. Like fully in itself, that's a job in itself. But she's responsive, and Airbnb tracks your response times, and it's not just because your superhost status gets reviewed, I think, every 2 months. So it's not like you get superhost and you just keep superhost status. It gets reviewed constantly. Not only is superhost up there now, and Airbnb has become an algorithm, right? So not only superhost kind of pushes you up the algorithm, people can tag their favorite properties, and there's categories to every properties. So that affects the algorithm too. So like it's all these little things, which is why we still handle the bookings. But the 2 most important things to managing the stuff out of state, in my opinion, are your cleaners, and you need a good handyman and a backup handyman. Like you need like, because the Wi-Fi goes out, batteries are dead, smoke detectors going off, like little tiny nonsense things. If you have to call emergency services for a toilet being backed up, like you're going to wipe out all your profit. So like having somebody that's either on payroll, like on a retainer. And, in some of these places, I can get somebody on retainer that for $300 a month that goes by and just checks to make sure the property like tells me there's problems. I may have to hire a different handyman, but at least they're kind of checking. But to have somebody that you have on a real hourly that's affordable, that is reliable, is the most important thing, because that's a make or break. It really is a make or break. Like I never knew what a problem raccoons were in my life before I owned short-term rental properties. And raccoons, not only are they a problem, but they're smart, and they can ruin the house. And so I just had a raccoon problem in a property I never would have thought I would have had it in. And I really had to have someone to go by and check what was going on, because the guest was like, I see a raccoon going up I was like, that's not. I knew it wasn't good immediately, but like I had somebody on site that could go and kind of at least calm down the guests, and then I had to get somebody in there. I had to get and I have pest control for every property, because that's always an issue. But like I had pest control get in there, and they were able to remedy the situation pretty quickly. But it was just like, if I didn't have anybody there, like the guests would have been like, what's going, like, you never know what kind of guests you're going to get. And so I think cleaners and handymen are the most important thing if you're going to own a property, especially short-term rental out of state.
Yeah, great feedback. And I love what you said. It's very, very accurate from my own experience as well. And I would say cleaners who have a keen eye for what is clean.
Definitely.
Not like when your kids clean the room, right? You want someone who actually
No.
is making sure it's clean, no hairs left behind, none of that kind of
Yep.
stuff. Somebody, they should walk in and not see any remnants of any previous guests. So really, really great feedback and information there. For folks who do want to learn more, they can check out your website. You go to Ralph Dibugnara, Dibugnara. So Ralph Dibugnara.com and learn more. We'll also put a link to your social media tags in our show notes. Right now, we're going to transition to our round of insights. Ralph, give me a failure or an apparent failure that set you up for later success.
I bought a few properties in 2005 and 2006 that were pre-construction. They were pre-construction and pre-market crash. So by the time the market was started to kind of go the other way, those properties weren't even finished yet. So I couldn't sell them, and they were worth like, I don't know, maybe 30, 40 cents on the dollar, right, at that point. So it was a strategy I was using at the time that was probably the wrong strategy I didn't have enough experience with. But I kept both of the properties long-term. So I rented them and kept them long-term. And holding real estate long-term will correct all your mistakes. So I was able to outrun my bad buys in a bad market by just basically breaking even for a bunch of years and then starting to make money after the market kind of turned around again. And one of those properties that I bought it for $210, it was worth $70. And it was in Florida, it was worth $70. And now I'm about to sell it. I'm about to list it for $370. So, I mean, it was 18 years, so it's a long time, but I outran all my stupid mistakes.
I love it, man. Great feedback. And that's the beauty of real estate, right? If you can control the day you sell, then
Yes.
You're likely going to make money. All right.
Yes.
Give me a digital or mobile resource you recommend for your business.
So for short-term rentals, I'll give you one of those because I think I have a good one. So I use airdna.co. For anybody, and you probably heard of that before. That's a really good one for me. I'll give you two, actually. That's a really good one for data. So if you want to look up an area and find out what a daily rate is, an average daily rate is, vacancy rates is, airdna.co is a great short-term rental site. And then we use Guesty for all our to manage all our Airbnb properties, GUESTY, and that merges every platform. So Airbnb, VRBO, Furnish Finders, Booking.com. It merges every platform into one, and it keeps one calendar. So you can list it on all the platforms and not kind of get your wires crossed at all.
All right, give me the book you've recommended or gifted the most in the last year.
The Psychology of Money. The Psychology of Money was a real, and I don't remember who the author is, but I could probably find a few. It's a great book because it doesn't give any advice. It doesn't tell you invest in this, don't invest in this. It kind of focuses you in on what your relationship to money is. And that's what it really did for me. It kind of explained to me what my relationship with money was growing up, kind of why I feel the way about it now, and what it really kind of means to me to go forward. So I thought that was a great book. And I just finished Tony Robbins' new book, um, which is all about finances. He basically, half the book is him talking about what he feels like the holy grail of investing is, and then the second half of the book is he interviews like I think 10 to 12 like major CEOs of investment firms on what they think the holy grail of investing is, and that was really a good read.
Give me a daily habit that helps you stay focused on your goals.
My day from like 4:45 till about 9 a.m. every single day is exactly the same, and I do it for that reason to get kind of rid of all the stress, because I know every single morning I got to get up and just do the same thing for the first 4 hours of the day, and that's I get up, I take a shower, I get dressed, I put an audiobook on, I go to the gym or I do some type of exercise. I finish the gym. By the time I finish the gym, I listen to a podcast usually for 30 or 40 minutes, and I try to get my body to a place where I feel okay, and I try to get my mind to a place where I'm kind of feeding information into it. So like the first 4 hours of my day every single day, and I know that's kind of something you hear a lot, and I don't think it's got to be the morning. I think it can be night, but I think having a routine where you're learning and doing something good for yourself physically is really, really important.
Give me your number one insight for selecting the right lender.
That's a really good question. I think that you need to have somebody who's going to explain the process to you and walk you through the process step by step, where you're learning, but at the same time they're leading in the right direction.
All right, let's lighten the mood. You are in Jersey. Give me your favorite place to grab a bite to eat.
That's a really good question. Wow, that's a tough one. So I live in Fort Lee. My office is in Edgewater. There's a restaurant here by the name of River Palm. It's a steakhouse. It's local. It's a great steakhouse. So I would probably say that would be my best place.
River Palm it is. And I lied. I'm going to give you one more question. So I was thinking about the lender question, and I think a lot of our investors, I'm going to ask, what's the number one insight for selecting the best loan? So not so much just the lender, but the loan itself.
Yeah. So as an investor, I want the product that's the least invasive and that's the easiest for my time, right? So, I've gotten to a point where, so as an investor, you can only have 5 or 6 mortgages that are agency loans, so Fannie Mae, Freddie Mac, or FHA. After that point, you can't have any mortgages attached to your properties that are one of those loans. You have to go to investor loans. I like the LLC loans the best, for the reason being that it does, most cases, it's a 15 to 20% down payment, but it gives me better protection legally. It separates every single property away from my personal name and my personal stuff. It gives me better insurance options. It gives me better write-off options at the end of the year. So I like the LLC loans as an investor because I just think that it protects me the most and it gives me more of a write-off ability.
Oh, I love it. Well, listen, great information today, Ralph. For those listeners who want to check you out, they can go to Ralph Dibugnara. That's RalphDibugnara.com. Ralph, thanks again for being a great guest, giving us some great information. We hope you have a good day, and we look forward to staying in touch.
Thank you for having me.